Hello guys, welcome back to my channel. Today's video will be about the ICT silver bullet strategy with a twist. What do I mean with a twist? Watch the whole video and find out. We are going to cover the different silver bullet session, which session has a higher win rate, and we are going to use other ICT strategies to increase the win rate of the silver bullet even further. So we are going to use other ICT strategies in confluence with the silver bullet to increase our win rate ratio in the market. Right? So before going into the video, I would like to hear from you guys. Which silver bullet do you think has the highest win rate, or which silver bullet session do you prefer? Comment with your answers below. Okay, guys, this lesson is going to consist of two parts. It's going to be part one, which is theory, which is what you are looking at the screen right now, and part two is going to be us going into the market and looking at a few market examples. Okay, so let's start with part one. First thing first, what you are going to look at is the type of ICT silver bullet setup. Right? What do I mean by that? In order for any person to trade any strategy effectively, you must know one thing. You must know your draw on liquidity, guys. You must know whether the market is going to go up or is going to go down. Where is your draw on liquidity? And the draw on liquidity can be either the following. What? One, you look at the previous daily high or low. Two, you look at your previous session high or low. Three, you look at your previous week's high or low. Four, you look at whether the market is returning to a current or old new week opening gap. Five, you look at whether the market is expanding away from the current or old new week opening gap. Right? Those are the five things that you must look at in order to draw your liquidity. The main emphasis here is determining the next mostly likely draw in price. Whether do you think the market is going to go up or is going to go down? Okay, so if we are going to this example, we realize that we have a higher time frame PDR. Let's say this is your previous day high and this is your previous day low, and the market is here. So you look at X. So let's say this. If we're going into the example, you look at, let's say this is your previous day's high and this is your previous day's low. This is your higher time frame PDRA and this is your higher time frame PDRA. You look at this. This is your draw on liquidity. You look at where the market is, and depending on the formation of the formation of the candle will tell you whether we have a bullish pressure or a bearish pressure. So now we have this expansion higher. This is a displacement candle. That means we have expansion higher. That means we expect price to go up. So price to the previous day low first. So the market makes a high, makes a higher low. Instead of making a higher high here, it makes equal highs. Equals high tells us that the liquidity above the high. This high is equal to this high, but then the market makes a lower low. When we see lower low here, we see this break of structure to the downside. Break of structure to the downside tells us that the market is now ready to go down. Why is the market ready to go down? Because the market is bearish, but because the market buys to sell and sells to buy, we expect the market to go and tap into the higher time frame PDR going. So when this break of structure occurs, we know that the market is now ready to go down. But because we created equal highs here, we know that above every equal highs, there is a ton of liquidity because people put their stop loss above the high. People, the market came here, people this as a resistance. So when they see this as a resistance, they even more sells here. And when the market, they are confident the market is going to continue going down. But as SMC traders, we know that wherever there are equal highs, there's tons of liquidity there. So the market has to move and clear up this liquidity before going down. Yeah, this liquidity and tap into a higher time frame PDRA. So let me give you a secret here, guys. Whenever you see the market in a consolidation or when it's ranging, in whichever direction it breaks structure first, that's where the market is likely to go. So here the market created the high, created the low, created a low. When this break of structure occurs, we know this is the break of structure indicating that the content in directional market is about to occur. Now we know that we need to go bearish, but we don't go bearish here because we know that after break of structure we must have a liquidity grab. So this is our liquidity grab. The market break structure to induce buyers or sellers into the market, then break structure to the downside. Then breakout traders see this as a breakout, then they try to go long. For us, we see this and we wait for the market to go into the higher time frame PD area before we sell. So this is where when the market comes and break this is not a break of structure. This is now in market structure, a change in market structure. So this is a confirmation that the market is going down. So you can look from the displacement high to the displacement low and look for a fair value premium market. So in order to sell, why are we looking for a fair value gap in a premium market? Because the market moves from premium to discount and from discount to premium. So you want to sell in a premium, you want to sell when the market is expensive and buy when the market is cheap. So you buy in a discount and you sell in a premium. So you look for a fair value gap in a market. So you're going to take your fib, place it here, and this is your equilibrium. Everything above this equilibrium is premium and below this equilibrium is discounted. So you're going to look for a fair value gap here. You find that you have a fair value gap here, which for some miracle it may align with an order block here, which makes it a very good entry. So this is where you get your sell. You put your sell here. You can either put your sell at the opening of the fair value gap or at the 50% of the fair value gap, and you hide your stop loss below, not below, above, sorry, above this high. Then you target this, and this is our next row. You can take partials when this high is broken, but this is our next likely draw only. So market is likely to go here. Okay, now that you know how to enter, let's see if the market comes into the gap outside the parameters of the trading session. Then you know that this is not going to be a high probability trip because you must enter between 3 and 4 for the London session, or 10, between 10 and 11, on between 14 and 15 for New York session, right? You're going to use two times frame, but I like to use three. So you're going to use the 15 minutes, the 5 minutes, and the 1 minute. Okay, so guys, now that we understand the theory part of the silver bullet, let's go to the market and look at a few examples. Okay guys, for our example, we're going to use Nasdaq 100 as our example, and we're going to use only one example because I don't want to make this video too long, right? So what you're going to do, first of all, you're going to start on the 15 minutes to identify your buy side and sell side liquidity, your draw on liquidity, guys. So you're going to look for 8:30 in the morning. This is 8:30 New York time. Then you're going to look at your buy side liquidity. What is your buy side liquidity? Your buy side liquidity is the previous day's high. This is our previous day. It's our buy side liquidity. Then you're going to look at your sell side liquidity. You're going to look at your previous session's high. Sorry, your previous session's low. Why are we looking at our previous session's low? Because it's the closest draw on liquidity that you can find. Right? Basically, what you're looking is you're looking for the next draw on liquidity. This is the next draw on liquidity. This might be the previous day's low. This is the next closest one. So what you do on the 15 minutes time frame, you look for your buy side liquidity and your sell side liquidity in the form of the previous day's high or a previous day's low or a previous session's high or a previous session's low or a previous week's high or a previous week's low. So let's go to the 5 minutes, and on the 5 minutes, I want you to mark out your silver bullet trading zone. So we're using the New York session AM silver bullet from 10 to 11. bullet. This is what you look for. So now you go to the 1 minute and you look for your entries in the silver bullet zone. If you look at this, then you understand this line is our previous session's low, which was our draw on liquidity. Our draw on liquidity was here. So our previous session's low was taken. That means sell side liquidity was taken. Now we expect the market to go up and attack the buy side liquidity. So now that means we are looking for buy position during the silver bullet hour, right? So you're gonna wait for the market to change correct. So the market making lower lows. This candle here with a long wick and a smaller body show us that selling pressure is now dying off and buying pressure is coming. So the market start making up candle. So when you come here, the market makes a high, then it makes a higher low. Then it breaks this high and makes a higher high. When it breaks high, we have a break of structure here. We have a break of structure with this energetic candle here. With this energetic candle, which also have a fair value gap here. Have a fair value gap here between this and that. So what do you look for? You look for the market to retrace back into the open of the fair value gap or the 50% of the fair value gap, or you can fill the entire fair value gap before going up, right? So now we expect the market to come into this fair value gap and go down and we take your interest because this our parameters are met. This is in between the hours of 11 and 10. 10 and 11. So you're gonna take your position here at the open. At the open here, you take your position. And what are you targeting? You the buy create. This is our buy side. What you get? How you enter a trade or how many position you enter a trade with. You can take partials here and here. When you take your partial, you move your stop loss into break even so that is now protected and you also have money. So if you don't want to take this entry here, wait for it to rectify breaking this low. This is a break of structure. This is a market structure shift. This is a market structure shift here. So you wait for the market to change structure here. So this is a change in market structure shift. So when it change, go up, then it comes down, and it goes up and break this structure again with candles creating fair value gap. You have a fair value gap here and a fair value gap here. So yeah, if you look, you have Fibonacci here. If you want to take this, you took it at this low, realize that this fair value gap is in the premium market and we do not buy in the premium market. We buy in a discounted. So the fair value gap that you are going to use is this one. Is this one. Because this is in a discounted market, this is in a premium market. So the market is gonna overpass this one, is gonna fail to go and fill this one. So you're going to take your position here at the 50% or at the opening of it, whichever one you prefer. This one went to the 50%, but the first one went to the open. So you can use the open depending on the size of the fair value gap. If the fair value gap is small, you can use the open. If the fair value gap is big, you can use the 50% to refine your interest further. So let's say you take your entry at the open, then you target the buy side liquidity, and where is your stop loss? Your stop loss is below this low. Your stop loss is below this low. Because why? Because the market is making higher highs and higher lows, right? So market this becomes a protected low. Expect market not to come below this low. If the market comes below this low, it means the market is changing direction and it's going further down. So you put your stop loss below this and you target the buy side. And if you check, all this went to hit take profit. So 5 minutes. all position, hit take profit. All your two position, hit take profit. Right? It's as simple as that. Like all position took profit, to take profit here, but it took the following day to hit take profit. So if you take your partials here and took your partials here, you move your stop loss to profit, you move to break even, so that your position is protected. You can also use these highs and lows to keep your your position open. So when the market is now here, you move your stop loss below this low, just up, just below this high, just below this low. You move your stop loss for trailing as the market goes up until you hit your profit, guys. As simple as that. If this far into this video, please consider subscribing to my channel, commenting with your thoughts or what you would like to see on my channel for future videos or anything else. See you next time. Peace out.